Financial market is an arrangement where lenders and borrowers of financial securities come in contact to exchange financial instruments at a predetermined interest rate. I know all what you are hearing now, there are big grammars, but let me break it to a layman level so that you have a thorough knowledge of it. Financial market. What about financial market? Talk about an arrangement where people that have excess cash and people that are in need of cash are brought together. Look at it. Financial market, we talk about a market. In economics, market is not a place. You have to put that behind your mind. Market is not a place in economics. Market is an arrangement that bring people in contact. So what about financial market? Talk about the arrangement that bring people that have surplus cash, surplus money, and people that lack money. They bring them together so that there will be what exchange of financial security, which is to talk about the money with a predetermined interest rate. That is what how much you are going to pay. Look at it. If, for example, as I have stated, I have 30,000 in my salary that I don't want to use. That 30,000 is an excess cash to me, which is a surplus, excess cash to me. And there is somebody that needs like 30,000 naira. You want to do something in a business, probably you want to buy goods and sell. So the person now have the 30,000 naira. I have excess 30,000 naira. So there's a surplus and there's deficit. The financial market is not that arrangement that will bring me, and it will bring the person that needs the money for business. It will bring us together. Then I will not lend my money to the person. The person will pay me an interest. That's what we refer to as financial market in the layman perspective. So we talk about a market that what it simply does, it brings the word lender. I am the lender, I'm lending money out. And the borrower, that is the person that wants to collect the money, to work in contact. Is that clear? So financial market is a market where lenders and borrower of financial security come in contact to exchange financial instruments at a predetermined interest rate. Financial instruments, they are, want about financial instruments, talk about financial securities or instrument of loans. What about financial instruments? Talk about financial securities or instrument of what? Loan. So if I ask you to define financial market, if you state that financial market is an arrangement where lender of money and borrower of money are brought together for a predetermined interest rate, you are correct. But the financial market just does one simple thing. It brings people that have excess cash, which is the lender, and people that don't have cash, that is the people that want to borrow. It brings them together and at a predetermined interest rate. That's why I state that if you go to bank and you put your money in bank, that is the excess cash. You don't want to spend that money immediately. It's an excess cash. So the bank now will now look for a customer that need money for a business. The bank will now give the person that money. Have you seen it now? So the bank will give that person the money. So it has brought you that have excess cash and the person that is in deficit together. The bank will now tell the person to pay interest for the loan they are giving there. While you that put the money in your savings account or your fixed deposit account, the bank will now pay you what? Interest. Have you seen it now? So it brought both of you together with a predetermined interest. Then the bank will not take their commission, which is part of the interest the person will pay. So that's what financial market is. Let me give you another definition of financial market. Financial market is a market where short-term and long-term financial security are being traded. It's a market where short-term and long-term financial securities are being traded. As we proceed, I will define every single terms in this definition because I want you to have a thorough knowledge of financial markets, because financial market is the hub of development of major economics like Singapore during the period of the Asian boom, the Asian tiger. One thing that made Singapore to develop very fast was the robust financial market. So I want us to have a thorough knowledge and understanding of financial market. So I say that financial market is a market where short-term and long-term financial securities are being traded. So let us define each of the terms there. But before we do that, let us look at a picture that depicts financial market. Look at it. This is the financial market. These are people, borrowers of money, people that need money. Companies, government, and individuals. White ones are what? Investors, people that have excess money, they are lenders. So look at what the financial market does. It simply brings these people and these people to work together at the what? Market. So the financial market, what it simply does is an arrangement that bring in contact those people that are in deficit of cash, those people that need money, and those people that have what? Excess what? Money. So the financial market, it brings them together. So let's look at some of the key terms that I have used in the definition of financial market. Financial securities. Please, when we talk about financial securities in economics as regard to financial market, financial securities don't mean that you should have money to be secure for tomorrow. That I am financially secure. I have 20,000 naira. I am secure for tomorrow. No matter what happens, I have money to take care of myself tomorrow. No, that's not financial security in economics as we get to financial market. So financial securities, they are instruments, which is financial instruments, such as shares, treasury bill, bill of exchange, etc., traded in the financial market. When we say financial security, we talk about what? Financial instrument. They are what? Instruments of loan. They are what? Instruments of what? Loan traded in the what? Financial market. So financial security, they are what? Instruments of loans. Financial what? Instrument. We refer to as what? Instrument of loan traded in the what? Market. In the financial market, that you buy the financial security and you sell the financial what? Security. And I gave you some example. Let us have a pictorial view of one of them. Then I will use that one to explain further. Okay, this is what? Treasury bill. This is a sample of Nigeria treasury bill. This treasury bill is just like a mere paper, but it has the backing of a law. You know, your money, 20 naira, 1,500, 200, they are just what? Mere paper. In themselves, they don't have any intrinsic value. There's no value attached to them. But the backing of the law now attach value to it. So this treasury bill also is. It's just like a mere paper. But the word backing of it by the law make it now become what? Something of value. So this financial security now, which is like example of it, which is a treasury bill, is what? It's a loan instrument that the government used to obtain loan from the what? Public. If Nigeria government, for instance, need money to execute projects, what the government can do if it does not have money, it can what? Sell treasury bill. It will sell this paper here that you are seeing now on your screen. It will sell this paper, which is this treasury bill, and people will subscribe to it. People will buy it, and when they buy it, they are giving government loan at the end of the day. If, for example, I buy 20 million naira treasury bill from the government through my commercial bank, that 20 million naira treasury bill I have bought, what it simply means, the government will give me this paper, which is an instrument of debt. I will give the government the what? 20 million. Then what I have simply done, I have borrowed the government what? 20 what? Million. At the end of the day, after 3 months, which the treasury bill will get matured, the government will now what? Take back the treasury bill, that is, they will buy it back from me, and they will give me my 20 million and interest. So when we say that they are what? Financial instruments, they are what? Loan instruments. Financial security are what? Loan instruments that are what? Traded in the financial market. That is, you buy them and you sell them. Then also we have another one as what? Treasury bill. This treasury bill is what? Instrument used for what? International what? Trade. How is it used? I will make it very brief because this is not actually what I want to focus on now. There is a time we look at all these financial instruments. So let me just make it brief. The treasury bill of exchange, it is used in international trade. Look at how it operates. I am an importer. Probably I can go to a company in USA to import goods. I might not pay in cash. What I will simply do, I will tender a treasury bill a bill of exchange to my cost, to the person that is supplying me, that is an exporter there in that country now. So if I like, let's say Toronto, we have Toronto here. Let me use Toronto. So I'm in Toronto. I will give them the treasury bill. The treasury bill will state a specific date, and and specific amount that will be paid toward the exporter, that the person that is supplying me. So it can be a year, 6 months, depending on the numbers of days we agreed on. So with the treasury bill, I will give the supplier will give me the loan at the date. The company, my bank will pay the supplier that amount of money. But we'll look at this in details. I want us to go to what we actually have for today. Then we have maturity period. Maturity period. When we talk about maturity period, talk about the duration it takes for financial security to be due for repayment. Maturity period, talk about the duration to which financial security is due for repayment. Remember, we talk about treasury bill. Treasury bill, if I buy treasury bill for the government, it is only after 3 months the government can pay me back for the loan I give today by purchasing the treasury bill. That 3 months is what we refer to as the maturity period. The maturity period, the numbers of the duration that it will take for the financial instrument to be due for repayment. This bill of exchange, if you look at this part of the screen, they write 30 days after sight. 30 days after sight. It means that the maturity period of this treasury bill is 30 days. It is only after the 30th day that the supplier will collect money. So maturity period is the number of days or the duration a particular financial instrument will be due for repayment. So I use calendar to depict it here. Talk about duration. The instrument will be due for repayment. Then we have what we call the long-term loans or long-term security. When we talk about the long-term loan or long-term security, we talk about financial instruments that have a maturity period of 3 years and above. Long-term loans, talk about financial instruments that have a maturity period of 3 years and above. This financial instrument, they get due for repayment after 3 years. They get due for repayment after 3 years. Then we have short-term loans. Short-term loan or security. Talk about those are security that has maturity period of less than 1 year. Talk about short-term loan or short-term securities. They have maturity period less than 1 year. That is simply mean that before you can pay, they can pay you back that money. It will be from 1 year, between less than 1 year. Like the treasury bill now says 3 months. That is the maturity period. So if government buy treasury bill, if you buy treasury bill from the government will not pay you after 1 month. They will not pay you after 2 months. After 3 months, that's when they will start paying, depending on their arrangement. So the maturity period talk about when it get due for repayment. While short-term financial security has a maturity period of 1 year. Long-term financial security has a maturity period of 3 years and above. Why? Okay, look at it. We talk about 1 year and 3 years. Then what about the middle? What about between 1 year and 3 years? What happened? That is what we refer to as the medium-term loan or medium-term security. They have a maturity period of between 1 to 3 years. Then what about type of financial markets? We have 2 types of financial markets. There are 2 types of financial market. We have the money market and the capital market. We have the money market and the capital market. Let's look at the definition of the money market. But before we look at the definition of the money market, I want us to review the second definition I gave for financial market. I said that financial market is a market where short-term and long-term financial securities are being traded. I said that financial market is a market where short-term and long-term financial securities are being traded. Now, money market. Money market is the part of the financial market where short-term financial securities are traded. Money market is a type of financial market or the branch of the financial market where short-term financial securities are what traded. If you look at the definition of financial market, I stated that financial market is a market where short-term and long-term financial securities are being traded, isn't it? Now, the money market is that part that deals on only what short-term financial security. That is, those security that has a maturity period of less than 1 year. So money market, they deal on what short-term financial securities. So we have examples of instruments traded in the money market. One thing about instruments traded in the money market, they are short-term financial security. We have the treasury bill, we have the bill of exchange, we have the treasury certificate, we have call money funds. These are what instruments traded in the what money market. That is, all these instruments you can see here, they have a very short maturity period of less than a year. Then the capital market. The capital market is a market where medium and long-term financial instruments are traded. The money market, the capital market is a market where the medium and long-term financial securities are traded. So the money market is the part of the financial market for short-term security, while the capital market is the part of the financial market for long-term and medium-term securities. Then let's look at the importance of before we talk about the importance of the financial market. Instrument traded in the capital market. Please, this is capital market. Instrument traded in the capital market. We have shares, which we have talked about in the previous term. We have debentures, we have stocks, we have venture capital, bank term loans. These are some of the instruments traded in the capital market. Let's look at some of the importance of the financial market. The importance of the financial market. We have more provision of short-term and long-term loan, avenue for saving excess funds, economic development of a nation, high liquidity, improved standard of living, avenue for investing excess funds. Let's take a look at each of them. Provision of short-term and long-term loan. The financial market help in providing short-term and long-term loan for individual, corporate bodies, and government for the purpose of investment and execution of capital projects. There are what called development bond in economies. If the government wants to embark on a certain developmental project, and the government does not have much money to execute such a project, the federal government cannot bring a development bond. It's also a financial security instrument. It's usually a long-term financial instrument. The development bond, now people will start buying this bond from the government. By buying this bond from the government will not have money to start the development project. Or if I need money now, if I need money for a particular project, I can go to the bank and take a short-term loan or long-term loan with my collateral. So the financial market help to provide loan for short-term and long-term loan. Another important is that they serve as avenue for saving excess funds. They serve as avenue for saving excess funds. Look at somebody saving here. He's saving. This one is coin. This one is paper money. They are saving here. So how does the financial market does this? They provide avenue for saving excess funds for or financial security for future purposes. What will simply mean? If I have 200,000, okay, let's assume I have 7.8 million. I don't want to use now, but probably in 2 years' time, I can go to my bank to put it there as a fixed deposit in my fixed deposit account. By so doing this, the bank is serving them as an avenue for me to save my excess fund. Even companies they can keep their money there in savings account or mutual fund account. So what they are doing is they are saving excess cash. Another advantage is that they serve as economic development. They help in the economic development of a nation. They help in the economic development of a nation. They contribute to economic development of a country by contributing to the growth of both the public and the private sector. Let us take a case study of Singapore. When you get to your SS2, you'll be taught about the Asian tigers, and Singapore is one of the Asian tigers between the 1960 to 1999, if I'm not mistaken. They taught as one of the Asian tiger. One of the things that led to the rapid growth and development of Singapore is their robust financial market. With a good financial market, investors can get money to start businesses. If I have a project now, probably I develop a system, or I want to build a car. I develop a car, I have an idea to develop a car. I have everything in plan. I have my business plan. But sometimes I might not have the cash to start executing the project. With a good financial market, I can go and get those loans to start with development of building the car. So what the financial market do, they will give me access to loan. And by so doing, if I start building my car, another person start developing another structure from money you get from the financial market, before you look, the economy will start developing. So investor will have access to fund. Investor will have access to fund, and also people will have opportunity to invest in people's projects. So it serves as a means for economic development of a nation. Another advantage or importance of the financial market is a highly liquid market. It has a high liquidity. It has a high liquidity. When we talk about liquidity, talk about the ability of converting an asset to a cash. Liquidity in economics, talk about the ability of converting assets to cash. Look at this picture. What does it depict? It depicts dollar forming from a tap, we're supposed to pour out liquid. So what does it simply mean? Liquidity, talk about the ability of converting assets to cash. For example, with the financial market, I have an asset. Let's assume I have a plot of land and I need money. I can easily convert that land to money by giving that to collateral to get money. Or I have a security, shares, and I need money. The share is an asset. I can easily convert it to cash by selling it off in the financial market. So with the help of the financial market, we can convert our assets to cash, which means that it helps to increase the liquidity of an economy. Another one is that it improves the standard of living. They also provide means whereby individual, corporate bodies, and government can invest their funds and others. What about improving the standard of living? People are employed in the financial sector, in the financial market. We have a lot of people working in the bank. We have a lot of people working in mutual fund organization and others. These people, by being employed in these places, their standard of living was increased because their income has increased. And as their standard of living increased, those around their household will also increase, thereby increasing the standard of living of the individuals. Okay. Lastly, but not the least, it serves as avenue for investing excess fund. It serves as avenue for investing excess fund. If I have money, I don't plan to spend any moment for now, 1 month or 2 months time. The financial market is just an avenue for me to invest that money. I can go and buy shares. I can go and buy stocks. I can buy government bond. I can buy treasury bill. I can even invest in a mutual fund. By so doing, I am investing my money. So the financial market serves as avenue for investing fund. So this is what we have done for today. We have talked about the financial market, financial institution, talk about the banking and non-banking financial institution. From there, we proceed to the financial market. Talk about the financial market. Define it as as a market that give us short-term and long-term loan. We also talk about the short-term loans and long-term loans and others. That's all for today. Thank you for being part of my class. God bless you and have a nice day.